Okay, so this is part 2 of charting silver and gold. Here I've got silver being charted out on a fairly long term, 1 week time frame, 1 week bars. And I just wanted to point out here the volumes, which are on the bottom, and just show you what the volumes have been through 2006, 7, 8, 9, 10, 13. You can see in 2013 the volumes went pretty high there, but it's been quite low ever since until just the last 3 weeks. And if you look here at that green bar, you can see the volumes have just skyrocketed in this last week so far, and it's still only Thursday. We've got up here the volume says this week 1.44 million contracts of silver have traded this week, whereas if you go back in time, say back to March, April, May, June of 2018, it's more like 21,000 contracts per week. So we've gone, it looks like it's averaging out maybe 30,000 contracts per week throughout the course of time. But now in the last week, we've got 1.44 million contracts traded in 1 week. So I wanted to bring this to your attention because I think this is really significant. The volumes have just increased astronomically. So that's silver volumes. I also wanted to show you the gold. We've got a similar story here as well. Let's go do the same thing weekly. So you can see, if you look back through the course of time here, this is going back to 2007 again, the volumes have been relatively low until 2013, where they really spiked. And then they went low again, 15, 16, 17, 18, 19. Even 2020, the volumes were low. And then now, look at this in 2022, just incredible, the difference. So just this week alone, 5.8 million contracts of gold being traded, whereas up until just the last few weeks, you'd see 200,000, 300,000 contracts in a week. Now we're at like 5.8 million in a week. Unbelievable. So that was one thing I wanted to highlight. The other thing I wanted to highlight on charting silver and gold, because a lot of people are looking at silver and gold in the physical form, bars, coins, and rounds, to supplement checking and savings account, because it's not digital, can't be frozen, can't be tracked, it gives you some separation from the system. I wanted to show you moving averages, and you will find that up here in the macro trends and other charts of similar style under indicators. So click on indicators and search and type in MOV, and it'll bring up moving average. Click on that and it's going to give you a moving average. So I'm just going to zoom this in a bit, and you'll see this line through here showing a moving average. Now this moving average is going to be showing weekly right now because I have the whole chart set on weekly, and what I want to do is put it on daily because I like daily moving averages. And so there you can see it. I'm actually going to switch this now back to candlesticks. Just it's easier to see with the red and green what the volatility is throughout the day. And of course, down here you can really see these volumes skyrocketing. So the idea with moving averages is, for me, and me alone, although you may find it entertaining, is I like looking at the moving averages to identify when is the best time to make purchases. And in the future, to supplement my income when I retire, I'll be looking at the moving averages to see when is the most efficient time or opportune time to skim out some profits or to sell a bit to supplement my income. So up here on moving averages, it says MA9. So it's using a factor of 9. But what I want to do is put in a 50-day. So let's switch 9 to 50. Okay. And now this blue line you'll see is our 50-day moving average. Now you can do this on your own, and what you'll find if you really look at it is you'll see on any given year there's typically several times where the price of gold is below the moving average 50, and several times throughout a year where it's above. And to me it's fairly simple, but it works and it's nice for peace of mind. When it's below, in my mind, it's a good time to buy. And in retirement, or when I'm wanting to skim out profits or supplement my income, when it's above the 50 moving day average, that would be a good time to sell a bit. So there's 50-day, and that's a decent way, especially if you're wanting to accumulate quickly or you're wanting to draw money out on a fairly regular basis. But I'm going to add another one in here under indicators again, and it's going to give me another one. So MOV gives me moving average, and now that's this bottom one. Under settings, I'm going to switch that from 9, which is just the default. I'm going to switch it to 200. So now I've got more of a short-term moving average, which is the light blue, and the one that's going to be more erratic. It moves around more quickly because it's a shorter moving day average. And then the darker blue line, which is the 200-day moving average. So now for someone that's pretty much set up, they're really not buying all that often. To me, a great way to look at this is you buy most aggressively when the price is below the 50-day and 200-day moving average. Until now, which is March 2022. You can see there's 1, 2, 3, 4, 5, 6 different times where it was above both, and just as many when it was below. So there's several opportunities throughout this last year where it would have, in my mind, been opportune time to buy and opportune time to sell. That being said, I'm not in any way suggesting trading, especially trading physical. To me, when you're getting physical, it really is long term. But in any case, that's something else I wanted to show you, was these 50-day and 200-day moving averages. The final thing I'm going to show you here is because in part 1 we charted 100-year silver, and this time I want to do 100-year gold. And just like before, macro trends and most of the charts of this style by default give you inflation adjusted, logarithmic scale, and these gray vertical lines are showing recessions. I just get rid of all of those. And now we've got 100-year performance of gold in real dollar terms, not inflation adjusted. And I just thought it would be interesting to highlight here, if we go back to 1922, which would make it 200 years, back in 1922, the price of gold was $20.84 per ounce. Right now, we're right around 2000, and so what that says to me is over the course of 100 years, the price of gold has gone up 100 times, from 20 to approximately 2000. Amazing how it's such even numbers like that, but that's the facts. So now what I'm going to do is get rid of this long line where the price of gold was actually, throughout here, it was pegged. The US dollar was pegged to gold, or gold was pegged to the US dollar. So I'm just going to get rid of that part on the chart here so we can see where gold just started floating on its own. And I wanted to highlight here, if you've ever heard in technical analysis charts, and I'm not, any expert on it, but most people have heard of a cup and handle formation. And I just wanted to show you here, right now, I am seeing one of the best examples, especially in a commodity like gold, of a cup and handle setup. This being the cup and this being the handle. Typically, in technical analysis, they will tell you that that is usually a very positive sign for a breakout. So I'm not guaranteeing that. None of this is financial advice. I just wanted to show you my favorite charting site right now, which is macrotrends.net, which you can see there. And I just wanted to follow up on part 1 by showing you the moving averages, which I think is a really, really cool thing, whether you're accumulating, whether you're just holding, or whether you're starting to liquidate over the course of many years. Many people want to retire for over the course of 20, 30 years drawing money out. And by using those moving averages, you can be quite strategic about your timing on it, in my opinion. So there you have it. Hope you have a great day. Thanks for stopping by.